In April 2026, a nurse in Austin named Rachel got approved for a $950,000 house without touching her savings for a bigger down payment and without paying a cent of mortgage insurance. She did it by taking out two loans on the same day instead of one, and almost nobody explains why that trick even works. Here's the setup banks don't advertise. Most lenders sell your mortgage to Fannie Mae or Freddie Mac after closing, but only if the loan stays under what's called the conforming limit, which sits around $806,000 in most counties this year. Go $1 over that line with a single loan, and you're stuck with a jumbo mortgage, which usually means a stricter approval process and a higher rate. So instead of one huge loan, buyers like Rachel split the purchase into two: a first loan that stays just under that limit, and a second, smaller loan that covers the rest. Rachel put down 10%, roughly $95,000. Her first loan covered 80% of the price, staying under the conforming cap. The remaining 10% came from a second loan instead of mortgage insurance. That's the piggyback structure, 80, 10, 10. Because her main loan never crossed into jumbo territory, and because she never crossed the 80% mark on a single loan, she skipped private mortgage insurance entirely, which was saving her $390 every month. If you want tricks like this the moment we find them, subscribe. We post 3 of these every day, and you'll never see them in a bank brochure. Here's the part that surprises people. That second loan isn't free money. It usually carries a higher interest rate than the first, sometimes 2 or 3 points higher, and it's often a shorter term, 10 or 15 years instead of 30. Loan officers rarely walk you through both numbers side by side because the monthly payment on paper still looks smaller than paying mortgage insurance. Rachel's loan officer mentioned it once, in passing, and moved on to signing pages before she could ask a follow-up question. Then comes the complication nobody warns you about. If home values dip even slightly in your area, that second loan can leave you owing more across both mortgages than your house is worth, because you effectively financed 90% of the purchase with almost no equity cushion. Rachel didn't know that until she read her closing disclosure twice, at midnight, 3 days before signing. Turn on notifications so you catch these breakdowns before you're the one signing paperwork at midnight. So why does a bank let you split one purchase into 2 loans that cost more in interest just to dodge a monthly insurance fee? Because the bank still gets paid either way, on both loans, for years. Rachel's savings on paper were real, $390 a month back in her pocket, but her second loan resets to a balloon payment in 12 years, a detail she didn't fully understand until we broke it down for her afterward. What happens the month that balloon comes due is exactly what we're covering next. Share this with someone about to buy a house.